The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And as always, I want to encourage all of our listeners, if you have a question or a comment, would just like to follow along with some of the topics we're discussing on the show today, then by all means, surf on over to theoptionsinsider.com. You can leave us questions, you can leave us comments, and you can find a lot more information about what we're talking about on the show today. And I'm usually joined by my co-host, my partner in crime here on the program, good old Don Schlesinger. Don was called away at the last minute for a family emergency. Luckily, we have a very able replacement ready to jump in his stead. Listeners may remember him from his recent appearance. He's been on quite a bit. It's been a while, but we've had him on before. He is Bob Krause, the CEO of the Volatility Exchange. Bob, welcome back to the show. It has been far too long.
Hey, welcome everybody. I have been listening intently to all of the shows, but you know, this is my chance to jump in and kind of counteract Don's sell it or don't sell it.
This is your chance to say you're wrong, Don, and he can't contradict you, at least till he gets back from France. So you have a week or two to bask in the limelight. All right.
But I am very excited about our guest coming up, Randy Swan.
Yeah, it should be interesting. You know, it's a very interesting audience, a very interesting aspect of the market that we don't really hit on that much on this show, which is, of course, volatility and how it pertains to some other aspects like financial advisors and asset managers who traditionally, they have no real penetration into the options and volatility realm. I'll give you a little bit of preview here, Bob. I was looking ahead of this show, just doing a little research, seeing perhaps if I could find some interesting financial advisor research on volatility or things, the common, the current state of wisdom, I should say, in the financial advisor realm regarding volatility. I came across a recent article from Wells Fargo, which has many financial advisors under its domain, entitled "How to Manage Your Volatility Exposure in This Marketplace." I said, "Oh, that's great. This is going to be. They're going to talk about downside hedges. They're going to talk about volatility instruments, all these kind of great things." And of course, it was an article about dollar cost averaging. So that, as a whole, should explain to you the current level of understanding and knowledge in the financial advisor realm.
I'm interested in whether he changed his name, you know, in order to drum up business, because I have a feeling his real name is like Randy Humpernick, and he picked up the name Randy Swan because he knew he was going to be in the hedging business.
I don't think he's a starlet in Hollywood, but we can put that to him when he comes on the show.
I will. Don't you worry. I'll get to the bottom of this whole Randy Swan last name.
This great mystery.
Humpernick dealie.
Listeners, that of course is Mark Sebastian from OptionPit.com. Mark, welcome back to the show, to you as well, on this great day of the implosion of the VIX cash.
It's beautiful today. What a wonderful day of VIX. The funny thing is, it's still trading at a 100% premium to realized vol.
Of course it is. What fun would it be if it wasn't?
You know, and the VIX futures are, you know, this is a combo of Congress getting their act together, a partial act together today, and the 3-day weekend. They're combining to get the VIX to its lowest level since, you know, kind of Q2 2007.
All right, sir. Sounds like a great segue for the volatility review. So without further ado, we're going to dive right into our volatility review segment.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the program where we look back upon the week's worth of volatility action. And as we were just discussing in the intro, there was indeed some action to discuss. So I think we'll kick things off in the S&P 500/VIX side of the fence, where volatility is coming off en masse today. So, Mr. Sebastian, take us through what you were watching this week, including today's activity.
Well, I think the big thing is that, the VIX and the VIX futures are really imploding today, more so the VIX. And it's a combination of the fact that, we were kind of expecting nothing to happen for Feb expiration, but that kind of got confirmed. So we're seeing VIX itself down at 12.5, and the Feb future now trading below 15. What's also been confirmed is that Congress isn't going to do anything in March. And so over the last week, we'd seen March kind of sell from 18 to 17. Now it looks like we're going to see March really start to take some of the heat that Feb took last month. So it appears, despite the fact that vol is low, it could get lower and stay lower. I don't know that I would buy the VIX future here. Would you?
Definitely not. We've been joking on the show in the past, and Bob, you may have heard us refer to this current period as the midwinter summer doldrums, because there really didn't seem to be much on the horizon to really jazz up volatility. The only thing we were looking forward to was, of course, the February into March debate on the debt ceiling. A lot of that being resolved, or at least pushed forward today, so that pretty much takes away the only thing we had on the horizon that could give us any real juice from a volatility perspective. So I'm not sure what we have to look forward to right now, unless it is indeed the actual summer doldrums starting in May.
Well, it sounds like you're starting to make forecasts already and jumping into the crystal ball section. But what I'd like to do is kind of counter or ask you to explain, Mark, Sebastian, that is. You said that, the VIX is imploding. I show it, somewhere around 12.5 right at the moment. Now, 1 o'clock on Central Time on Friday. But the realized volatility that I show on our website on the S&P is around 13, which is, okay over the last 21 days, but it's not half of what the VIX is. What do you mean by half? Just like over the last week or two or something like that?
Yeah, I mean, over the last couple since kind of the debt ceiling, the fiscal cliff got answered, and then now that this debt ceiling is pushed off, we're just seeing everything just get chopped. Realized volatility is at 6%.
Yeah. Okay. So since
probably
then,
dropping more.
Yeah. So since then is what you mean. Right?
Yes.
Yeah.
Yes.
Okay. I got it.
Volatility is like physics. It's all about frame of reference.
Yeah, absolutely. And this is a really good, interesting learning point for, I guess the newer guys or even some of the veterans that, it really depends on how far back you go and because right around the first of the year, we had that massive move when they were trying to, decide or not decide or whatever on the fiscal cliff issue. And, since that was decided, then volatility just collapsed and the market really hasn't moved. It's, slowly, I guess, risen, but it's, been very, very stable or quiet for most of January so far.
Yes, it's ironic. We've been in one of those strange periods where the only appreciable realized vol we seem to have gotten has been to the upside for the most part, except for some days like today. So yeah, it's been an interesting time to be watching the realized vol. Speaking of realized vol, Bob, what have you been seeing? What's been catching your eye out there in NASDAQ land? Certainly not a quiet period for the NASDAQ over the past couple of weeks.
Yeah, the NASDAQ has been holding its own. I mean, keeping up with the S&P. I wouldn't say it's much different really, other than the level is, normally a little bit higher. But what I would like to do is actually, because Don is more of an equity guy, and I would say, my roots are in the commodity markets. So, I'd like to actually jump into a little bit more of the commodities, especially, Rob Heinemann was on the show last week, and he really sparked my interest in some of the agricultural products. I really enjoyed listening to that show. And so I started, kind of looking at the realized volatility in some of the agricultural products. And corn volatility is kind of the lowest it's been in a couple of years. But if you go on our website and look at the maximum chart, all the data, I think we have something like 35 years worth of data in there. It's just this perfect oscillation pattern. I've never seen anything so regular and predictable, if you will. It just goes up, it comes down, it goes up, it comes down. It's just over and over and over with sort of the same amplitude, the same time of the year. Well, we all know that many of the crops are very seasonal, and in fact, my very first foray into volatility, I wrote a book on the seasonal patterns of volatility. And of course, you would expect to see some kind of seasonal pattern with, say corn or orange juice. It goes crazy in the winter when there's the threat of frost in Florida and, that kind of thing. But I was very, very surprised to find a seasonal pattern in things like, the S&P, euro dollars, and currencies too. And so it was a very eye-opening book for me even to produce it. In fact, one of the agricultural traders offered me $10,000 not to publish my book. So I thought that was pretty cool.
I think you're onto something when people are paying you to keep it quiet. That's good. I like that. But I think you're right, Bob. That's an area of volatility, really, that we don't explore often enough on that show. And I think last week's show was almost an accidental eye-opening for a lot of us on what's going on in the commodity vol landscape. And perhaps it's something we should address more often here on this program, because you're right. So many people are looking farther afield for liquidity and indeed volatility exposure. They're moving beyond traditional equities and moving beyond traditional indices into things like the metals, like the ags. Corn was a huge product over the past year, remains a very popular product. So perhaps it is something, as we continue with volatility views down the road, it's something we should look at again and perhaps even start incorporating into the vol review, because so many of our listeners are sure have at least some exposure to ag volatility or metals or something like that.
Yeah, and when I say, I'm an old commodity guy, I'm not portraying that I'm some kind of expert or
no,
something.
You're portraying that you're old.
Yeah, I'm just old, right? And it's true, because back when I first started in the business, oh God, it was about 25 years ago when I started at the CME. They put me in the agricultural marketing effort, and so here's this whippersnapper kid. And I have kind of a baby face, maybe not so much anymore, but certainly then. So I'm, out of college. I'm 22. I look like I'm 16, and here I am, traveling all over the country to, North Platte, Nebraska, and stuff like that, and teaching these cattlemen how to hedge their exposure with options.
I'm sure they appreciated that deeply.
So it was hard getting the credibility. It's like, well, shoot, son, I've been feeding these cattle for 40 years, and you're going to teach me how to, that kind of thing. So, and these are the biggest speculators in the world, if you ask me, the cattle and hog producers. They, you teach them about hedging, but they only want to hedge when they're at the top of the market. They want to be able to go to the corner diner and tell everybody how they, hedged, at the peak. But, anybody that hedges any other time, it's, they just don't have a story, and they want the story, and they want to, basically show everybody how wonderful they are. The other problem with cattle is that it's always in backwardation. So in other words, the deferred contracts, now I don't know what it is lately, because I haven't been in the cattle area for many years, but at least back at that time, they were always in backwardation, which meant that the deferred contracts were always lower. So that the cattlemen who want to hedge, they have to sell the board even lower than where the spot price is. And so you're locking in not necessarily a loss, because it kind of depended on your cost of production, cost of feed and all that. But, it just sat really badly with them that you're giving up, 2, 3, 4, 5 cents a hundredweight to hedge the the cattle, at a price even lower than the current market. And they kind of knew, that's in quotes, and I'm sitting here like with my hands up in the air, which I know you can't see, but anyhow, they knew, that it was at least going up to the spot price, that kind of thing. So what cattlemen often would do is buy the board. So they would end up being long, cattle because they're feeding it, and then they go and they buy futures too.
Because they couldn't handle hedging not at the top.
You can buy the board. Yes.
That's fantastic.
It was really an eye-opening.
We like to call that Texas hedging. Maybe that's
exactly where it came from.
Now I know the origins of that term. I had heard that for years, and I just assumed there was some crazy oil guy out in Texas, but the cattleman makes even more sense. Well, that certainly shines some light on some of the liquidity and action we see going on out there in the ags and the commodity realm.
Yeah, I wonder if that's what Curly was up to from City Slickers.
You think he was that slick?
I think Curly was. I think Curly had his double cattle hedge on, and that's why he wanted to make sure he got that one last ride.
But you're right.
Let me just jump to now JGB. I wanted to jump to the interest rates and T-notes. We got down to a realized volatility of 1% in JGB in mid-November. And right now it's like 1.86, so it's 86% higher. It's it's almost doubled, but the average volatility for JGB is 5% volatility, and 10% is not unheard of. So you can buy Japanese government bond volatility at 1.86% now. Well, I don't know what the implied is. That's the realized, and the average is around 5. It's kind of the same story with T-notes. We got down to 2%. We're now up to 3.5. 2% was last month. That was just in December, and that was like the lowest low that I've ever seen. And now it's 3.5, so it's had a nice run, except that the average is around 6.5, and 15% is not unheard of for T-notes. So the volatility is still very low in the interest rate products.
I like this, Bob. We have very much of a broader perspective here on the vol review today than just our standard flavors of VIX and NASDAQ vol. So maybe that's something we should explore indeed for future episodes, is opening the umbrella to the entire world of more than just our standard flavors of VIX and NASDAQ vols. That's something to keep in mind for future episodes. But now, dear listener, we have to close out our volatility review and dive right into a very intriguing volatility viewpoint with our guest, Randy Swan.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky music means it's time once again for the Volatility Viewpoint segment. That, of course, is the portion of our show where we welcome on some guest from the world of options and derivatives and proceed to pick their brain about volatility and all things volatility related. And today's guest is an interesting one because it helps us discuss a part of the show we haven't discussed very often here on Volatility Views, which is the whole realm of the advisors and asset managers and the degree of, or we should probably say lack of, penetration of options and indeed volatility knowledge in that space. So our today's guest is going to help us discuss that a little bit. He is Randy Swan, the co-founder, of Swan Wealth Advisors. Randy, welcome to the program.
It's good to be here with y'all guys today.
Yeah, we're glad we can have you on. Like I said, this is a very underserved aspect of the derivatives market, and certainly one that really intrigues us. But since this is your first appearance here on the program, why don't you go ahead and give our listeners a bit of an overview of your history or your background in the options and derivatives markets, and then what you guys do over there at Swan Wealth Advisors.
Sure, thanks, Mark. Well, my background has actually started out as a CPA working for a big accounting firm. I was an avid investor and learned the options market really more as a retail trader, investor at the time. And that thing grew over several years, and eventually I left being a CPA and started my own firm, Swan Wealth Advisors, in 1997. to start a strategy which we call the hedged equity option income strategy. So we've been doing this strategy for about 15 and a half years now.
Well, that certainly makes you one of the early entrants in the option space from an advisory perspective, that's for sure. I mean, fast forward 15 years, there still aren't that many of you. But 15 years ago, there certainly weren't many advisors really who did anything of any substantial interest in the options market. Now, I know a lot of what you guys do over there involves overlays, and overlays are a very, I think, popular topic these days. But for some of our audience who may be unfamiliar with the concept, why don't you walk them through exactly what an overlay is and then what you guys specifically use them for over there at Swan?
Okay, well, our typical strategy involves buying an underlying. So what we refer to option overlay strategies is we'll allow another advisor or another money manager to actually manage the underlying securities in the portfolio, and then we'll do our option strategies on top of that, or as the term refers to, overlay that on top of the equity. So typically our examples is either using another money manager to pick the securities, the equity securities, or another situation that we have frequently is when someone has some stock that they've held for a long time, do not want to part with that stock, and they transfer those securities in our account, and then we just typically do our option strategies on top of that. So those are the two most frequent examples that we're actually doing right now within our firm.
And do you typically, obviously you're going to adjust that overlay based on the needs of the client. So if someone comes to you, do you offer, let's say, an income overlay versus more of a vol-focused, perhaps hedging type overlay? And do you offer different flavors, I suppose you could say?
Yes. Part of the first component of our strategy would be providing long-term protection by using put options to protect the downside risk. And the second component would be the option income strategies. Those strategies range from doing strangles on a monthly basis to butterflies and calendars and ratio calendars and stuff like that. So that's the income component is a big part of what we do. But yes, we do offer the systematic hedging on an annual basis.
So you have two components.
Randy,
go ahead, Bob.
Hold on a second. This is Bob. Now, if you have another advisor, actually kind of advising the client on, what the underlying should be, and then you come along and put in an overlay, logistically, that sounds difficult because, the positions may not be in the same account, or if it is in the same account, I'm not sure how that would work. And, please explain. But, for instance, if you just, bought some Microsoft and your advice is, it looks like premiums are expensive now, we just like to sell a call. Well, if they're in two different accounts and you're selling a call, well, the margin on that could be tremendous. But if it's in the same account, then it's a covered position and, there's really no margin. So how do you get around that kind of situation?
Well, typically in the first situation where it's in the same account, I think you mentioned correctly, it's not really a big issue. The second situation where it's not in the same account, then we have to transfer a certain number of cash over to, one, purchase the put option as well as engage in our monthly income strategies. So it is more complicated. It's a little more work for us to have them separate accounts, but we've been able to manage that fairly well. And so I think it all comes down to how much cash you need to transfer over to implement your strategy.
Now you have two aspects of your strategies there that are both very volatility dependent. You have the income generation, the call writing strategy, which obviously is vol dependent, and then of course you have the long premium hedging side of the equation, whether it's a long butterfly, a long downside put, obviously also very volatility dependent because that determines how much you're outlaying for that. So let's talk about a little bit about how you incorporate vol and vol level into your strategies. I mean, right now we're in an environment where overall levels of volatility are trending down. They kind of come off post-fiscal cliff. How does that impact, how does that factor into your calculations when you're creating these overlays for your clients and for the sub-advisors who work with you?
Well, first of all, we have a strategy that always hedges and buy and put options. So we don't make a determination at a certain point in time that vol is low or it's high and now's the time to hedge or not hedge. So we systematically hedging all the time. Now, that being said, obviously we like to be buying puts during times of low volatility, and hopefully that over time volatility increases. So now I'm just looking at the VIX today. I think it's, a 13-ish. That's probably about as low as it's been for several years now. So now is actually a very good time to buy that.
Currently trading at its lowest level since June 7th, 2007. Close here would be its lowest since April of 2007. It's trading 12.5.
Correct. So now's a great time to be hedging. I mean, it seems like most people think that there's, at least based on the volatility, there's not a lot of risk out there in the market. And of course, as option traders that we are, we all know that that's usually the time that you want to take the other side of that trade. So I'm definitely someone who we would like going long vega or long volatility right now.
Now, obviously, I want to get to that client perception of vol in a second, because that's very important as well. But you talked about how you continually have to generate those hedging components of your portfolio. Do you go out there and say, I want to allocate X percentage of the portfolio to premium outlay for this hedge, and that's how you mitigate perhaps your vol exposure? Or do you perhaps in some really high vol environments, do you get into writing spreads to offset some of that? Or how do you really mitigate it so you're not eating up and wasting basis points from that portfolio, overpaying for, let's say, things like tail risk?
Well, first of all, part of our strategy, our basic strategy, involves not only selling covered calls but also puts. So we're doing put spreads. So that takes that into account in terms of trying to minimize whatever impact of the cost of the hedge or the volatility exposure in a declining volatility environment.
So, Randy, do you find that you do more? So, are you hedging a portfolio, or are you looking at individual names, or both?
No. We're typically hedging something like the S&P 500 is our kind of bread and butter. So we're not out there trying to hedge on individual stocks. It's more the market in general, and that's typically the S&P 500.
So I would come to you and say, I've got XMX dollars. You would kind of calculate a beta to the S&P 500 and then run a hedge. What do you do about some of the breaks in correlation and some of the problems like that can arise with taking that approach?
Well, that's something that we have to sit down and talk with the client, discuss that and discuss the risks of, the non-correlation or whether or not this is the appropriate type of hedge for that. That's definitely an issue that we have to deal with. But typically most of the clients that have come to us realize that our primary strategy revolves around the S&P 500. So typically on an annual basis, what we're trying to do is take that underlying portfolio and try to, we think, match it up with the right number of S&P 500 puts that will give a certain risk exposure over that year. So in our examples, we're typically buying 2-year puts, holding them 1 year, and trying to give the client about a 7 to 10% maximum downside exposure during that year.
And that 2-year time period, is that just to try to avoid some decay and avoid some roll risk and make it a little easier for you on the execution side?
Absolutely.
Yeah, because you start getting into those nearer term protection, you have a lot of other complexities that get involved in there that can make it a little bit more difficult for not to mention the execution component of having to roll them every month or every quarter or anything like that.
We try to avoid being in a situation where, if you take something like the fall of 2008, where you're trying to insure your portfolio when the volatility is up at 80 or 90. So we think doing it on a longer term basis, yes, we know we're paying a little more in terms of the volatility skew, but we're never going to face a situation where we're trying to rehedge the portfolio in a volatility of 80 or 90, or at least we haven't yet.
Hey, Randy, do you, when you're selling the calls, I guess most people would call that a fence or something like that, what you've described. Are you selling the calls long term as well, or is that shorter term, like a month or 3 months or something?
No, typically we're selling our short term calls and puts about 2 months out. And we typically are holding those anywhere from 30 to 45 days, depending on how the price movement of the market occurs during that time period, and then rolling out to the next trade. So we're trying to take advantage of the quicker theta or the rapid decay of the options we're selling versus the longer term options we're purchasing.
Mm-hmm.
You sound like a man, Randy, who's read some of those OIC studies recently on that exact topic, and they found some interesting results on different ways to construct your collar, doing exactly what you're talking about. So it sounds like you've taken that advice to heart.
Absolutely. We love those studies. Those studies are used all the time for us when we get in conversations with people that say, this sounds too good to be true. And we say, no, look at these studies. And actually it's a good situation to be able to use those as kind of a backdrop of what we do. I think we manage ours a little more actively than the passive collar strategies.
So what do you benchmark against on your premium side? Or do you look at like the BXM as your benchmark, or how do you show performance to clients?
Well, we always compare ourselves to just the S&P 500 because this is a non-leveraged play. In our strategy, it's more of a investment portfolio than an actual just a pure income play. Of course, that's part of the strategy, is to generate more than enough income to help pay for the hedging costs over time. But no, we don't really benchmark ourselves to any of the buy or right funds or anything like that, just because, quite frankly, most of our clients aren't even aware those exist.
Hey, Randy, do you stick with, let's say, index options only, or have you been using the VIX futures, VIX options, those kinds of things, playing volatility as well?
In our portfolios, we're typically dealing with the S&P 500, whether the SPX or the SPY and the Russell 2000. Very minimal entryways into the VIX. In terms of VIX options, never use the VIX futures. We, quite frankly, obviously I'm aware of a lot of the studies that show that it's very difficult to buy the further out futures and have the skew go down against you. But typically when we think that we're buying long-term put options, we're protecting against not only price but volatility. So we like that as a play a lot more than just trying to play increase in volatility to protect your portfolio.
Now, Randy, you mentioned a couple times here now the clients when they approach you for these types of things. Do you find, whether they're end user clients, whether they're other advisors looking to you for a sub-advisory agreement, do you find they're coming to you because they're cognizant at all of these things like low volatility levels, that sort of thing? Or are they just coming to you saying, hey, I have this equity portfolio and I heard you're the man who could hedge it, but they have really no cognizance of saying, oh, this is a good time to be hedging, or this is a good time to be generating income? Or are they really aware of, I should say, really the minutia of what you guys do? Or are they more just kind of conceptually ignorant, I suppose you could say?
Well, I think you see the whole range of every type of client, whether it's an advisor or individual client trying to come to us. We deal mostly, almost exclusively, quite frankly, with other advisors. So most of the advisors are aware of certain volatility environments, whether it's low or high, but don't get in too much in the weeds or the minutia on individual volatility issues. But of course, everyone's aware that at the end of 2008, beginning of 2009, you were having to hedge your portfolio with a VIX of 40-ish. And so, like I said, we said earlier in this broadcast that now's a good time to be buying volatility, I think.
Now, Randy, here's my question: how much did you pay Taleb to use the term black swan in his books? And did you consider paying a big enough sponsorship to have him call them Randy Swans instead of black swans?
Nope, I didn't even think about that before, so that's never entered my discussions with anyone.
Yeah, no, I mean that's so no one's pointed out the terrific coincidence that you're running a hedge fund, a hedging operation, and your last name is Swan, and everyone calls those types of events black swans. It's just. It couldn't be more perfect, in my opinion.
No, I guess I stand corrected. People do bring it to me all the time. I guess I misunderstood your original question, but no, we love it. As Mark's seen in our logo, we've got some of that built into that play of the whole name Swan. So yeah, it was a good situation, definitely.
I suppose since your name actually is Swan, it somewhat insulates you from the hordes of lawyers that may otherwise be heading your way with something like that. You can definitely claim fair use with that. But Randy, we hit on the client aspect. Another interesting question on that, and we talked about the overall perception that volatility is lower. Certainly they're beating that drum to death on places like CNBC and others. I mean, today with a day like VIX at 12.5, VIX cash at 12.5, I'm sure they're just beating that drum even more right now. So does that in turn make your job easier or harder? Are people coming to you saying, wow, vol is low, this is a great time to come and execute a strategy like yours because the protection is cheap? Or are they on the flip side of that saying, wow, vol is low, I don't really need to hedge, there's no volatility risk out there, and so it's a little bit more difficult for you? Which way does that kind of lean in an environment like this?
You know what? I think people come to us right now mostly through advisors that see the big picture of what's going on, and they're not so concerned about the VIX being at 12.5 or 13 right now or 20 a year ago. They're looking at the big picture and saying, hey, I think there's risk out there. The traditional forms of asset allocation doesn't solve the real problem of market risk. And of course, I think that people these days are getting a little more knowledgeable, although I still think they have a ways to go. in situations like this. So I think overall, people are coming to us because they perceive there to be risk out there. And of course, we think we have the solution.
Have you toyed with the idea down the road of maybe expanding your repertoire of hedging instruments to perhaps include a more direct, quote unquote, volatility type hedge, like, let's say, a VIX future or a VIX option, or in the case here, we're talking today with Bob from Volex. They, of course, have the forthcoming realized vol future. So there's a lot of different products that you could turn to for a more direct type volatility hedge. Have you ever thought about incorporating those perhaps in lieu of or in addition to the downside S&P puts?
Absolutely, I've thought about it. It's something that it's probably going to be done in the the next year or so, but right now it's not immediately on the plate. Part of our process, as you know, it's taking most of our clients or our advisors' clients from a knowledge level that's very low to even getting up to explaining what volatility is and different types of income trades, whether it's butterflies or calendars and stuff like that. So I think the VIX is probably another layer on top of that over time will be part of it.
And then you understand the basics first before you can walk them through something like a derivative of a derivative.
Sure.
Randy, I think one more thing here before we'll wrap it up. You and I first met last year on a panel at the Options Industry Conference talking about a very poignant issue for the options industry these days, which is, of course, financial advisors and their complete lack of understanding of, or perhaps even interest in, options and using options to hedge and volatility and the components of options trading and all those things like that. And it was an interesting conversation, and one I think we could quickly revisit here. Obviously the penetration in your space in the advisor, sub-advisory, asset manager category is virtually non-existent. And that's one of the reasons why we wanted to have you on today. You're one of the few firms that plays in this space. So really, why do you think that is? Why do you think people who are otherwise very sophisticated, very knowledgeable about the markets, are still clinging to very outmoded traditions like using 20 to 40 plus equities to hedge their exposure rather than turning to a direct hedge like a volatility product or an option product to hedge their exposure? Why don't they make that leap? Why don't they get it yet?
Well, I think in the conversations in the past, we've always kind of come back with, I think, about three different reasons. I think for the most part, advisors in the past haven't been comfortable with using options. It's kind of, as we've said, that going over to the dark side, derivatives, evil. I think as time has come on after the 2008, 2009 sell-off, people have realized that asset allocation isn't the end-all be-all that it was supposed to be, and that they're obviously having to maybe go out of their comfort zone to finally say, yes, maybe I will look into something like this. I definitely have seen it in our business in terms of advisors willing to do this. Our business, quite frankly, has grown multiple times over the last year. So we think we're at the tip of the iceberg of what eventually will come down and this market will make up. But I think the other two issues really have been technology. I mean, for us as a firm, 3 years ago was very difficult to really scale up our operations, really offer what we do on separately managed accounts. I think right now we're managing probably around 1,700 accounts, and that really wasn't even possible 3 years ago. Some of the firms that have really helped us with their technology and ability to scale this up and have a more, I hate to use the word liberal view of approving clients for option trading that have little or no experience. And then I think the final reason is just risk. People see there's risk out there. They realize if something they need, if they don't necessarily believe it, their clients are fearful or feel like there's a lot of risk out there. And so the clients really are the in demand for what the advisors are going to give them. So to the extent that the individual investors out there who are looking for advisors, they're going to demand that, and they're eventually going to find people like us.
Hey, Randy, I thought of a question before we let you go here. There's one benefit to a volatility product, either VIX or ours, in the respect that, it hedges you no matter where you are. So let me give you an example. Suppose that your strategy, which I actually don't know exactly, but let's say you always bought a 2-year at-the-money option, and 3 months go by or 6 months go by, and you find out that the market had a nice 10% rally, and now your put option is 10% out of the money. So what do you do? So now you can roll up the put. If you're trying to be at the money, you can just leave it there and maybe buy another one so that your delta is, roughly half or whatever. There's a lot of things you could, I guess, do, and maybe you'd like to expound on what it is that you do when in a situation like that. But the one advantage to a volatility product is if you buy it and then even if the market goes up, say 10%, and then volatility explodes, well, you're still getting the hedge no matter where the market is. You're not like wasting 10%, before you get to your strike again with an option.
Sure, that's a very good point. What we typically do in our strategy is we're trying to hedge, as we said, on an annual basis. So we're not trying to re-hedge a client every quarter, every 6 months, because as you know, when you start out hedging it with an at-the-money put, you're going to have limited exposure on the first, let's say, 10%. And as the market goes up further away from that short strike or that strike, then of course you're going to get a higher delta. You're going to pick up more of the upside capture ratio. So we struggle in up years trying to get as much of the upside capture as possible. Historically, we've been able to get 70 to 75% of the upside capture ratio, and of course, part of that is the option income that we use in conjunction with the put. So, in a year like last year, we would not want to re-hedge when the market was up 7 or 8 or 9 or 10% for the year, because our experience is we like the market run for the remainder of the year, and then we'll try to lock in those gains as much as we can when we sell the original put and buy a new put. But I think your point is very valid. I mean, I think the other things that we do or we've started to do in some of our portfolios is maybe keep on the put option and maybe do some out of the money calendar put spreads on the market to protect some of that gained income or that gained upside during the year. That's one of the things that we've done.
Well, Randy, I want to thank you for taking the time to join us on the show today. And before we wrap up, are there any thoughts you'd like to leave our listeners with before we end the segment here today?
I usually say there's market risk out there. What are you doing about it?
Well, there you go. Succinct and to the point. I like that. All right, Randy, thanks for joining us today. And we'll definitely have to bring you back on the show again down the road to look back on perhaps some of these developments and how volatility is impacting your strategies down the road.
Sounds good. Thanks a lot, guys.
Great. Thank you. All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our final segment, our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball segment. This is indeed our final segment where we peer into the murky future and attempt to divine what the volatility gods hold in store for us. And as Mark and I, we kind of let the cat out of the bag there at the top of the show, kind of giving away what we're thinking for our crystal ball segment. But indeed, with what's going on today, with so much volatility coming out of the marketplace, particularly from a VIX and S&P 500 volatility perspective, the one thing we were looking forward to that might have perhaps juiced the market a little bit and given us some vol in the future seems to have been taken away from us, at least for the near term. So hence the massive vol sell-off today. And Mark, unless we get some dire earnings, unless Apple really blows the doors off to the downside, do you think we're getting any vol in the appreciable near future?
Well, Mark, 5 years ago this weekend, we were having a long weekend over Martin Luther King Day, and some punk in France almost set the financial crisis off 6 months early. So, truth is, you never know what could happen. But I think that we're heading for some slow times. But the one thing I would remind people is when vol is low and risk is really low, you have to be sure. We trick ourselves into wanting to strap on risk. Be smart about how much risk you take and how big your risk appetite is as you trade. Low volatility becomes high volatility much faster than high volatility becomes low volatility.
You're right. I discounted the rogue trader factor. So perhaps you should
never know.
You need a rogue trader.
Maybe you break into the offices of Interactive Brokers over the weekend and sell every single government bond they have on the books.
There we go. So perhaps everyone listening to the show should have a rogue trader strangle lurking in their portfolio, just in case.
The Rogel.
The Rogel. I like it. Coined a new term here today. Bob, what say you for the future of NASDAQ vol right now?
Well, I would like to first, before I get into that, is sort of counter Mark's thing. We actually have a volatility strategy article, which I don't remember Don saying, but then again, I haven't caught every show, so maybe he did. But we have a volatility strategy article about the 4 drivers of volatility. So there's, we all know about mean reversion, autocorrelation. Well, there are 2 others which I think are critical, and that's shocks, which is Mark's talking about, so we're at 12 and all of a sudden, some crazy trader in London or whatever,
Probably
blows up
France.
Blows up the market.
France.
Right, blows up the market, and it's like, oh my God, what the hell's happening? And, volatility explodes. But the opposite is actually almost as likely, and that's a relief. So you're building up into a situation kind of like a known event, such as the fiscal cliff, and volatility is creeping up higher and higher as we get closer and closer to this, deadline date or whatever. And then, whatever story comes out, volatility just absolutely craters after that. And,
I know what you mean.
And I was I'm looking at a chart of the VIX, and the VIX index was at 23 that day, before the fiscal cliff. And in 2 days later, after it was decided, we were at 14.5. So it dropped like 50% in 2 days. And
it got crushed.
Absolutely. So, volatility can have its spikes, so to speak, on the downside as well. You're never going to get those, sort of during normal markets where it's 15 and then it goes to 6. But you can get that when it's, 25, 30, 45, and then all of a sudden it drops down to 20 kind of thing. So, so we just have to be careful, our listeners to make sure that they understand that, volatility spikes on the downside as well.
So when you have the Rogel on, get out of it quickly. The moral of the story.
Absolutely. So now into the crystal ball section, or the true part of the crystal ball section, I kind of brought up corn, and corn volatility is really the lowest it's been in a couple of years. And so this is, if you look at the charts on our website, you can see that there's a fabulous pattern, especially if you took a real long-term view, an absolutely gorgeous, oscillation pattern with corn volatility. And right now we're kind of at the low. So, who knows if buying volatility is going to work, but, we're certainly historically at the low end. And I also brought up about interest rate products, about JGB and T-notes, and how they've spiked up. They're almost double from the low as far as realized volatility, but they're still like half of what average volatility is, or even more. So, for instance, what I said was JGB was at 1.86, but the average is around, 4. So that's, I guess, about half or double to go kind of thing. Same thing with T-notes. Now we're right around 3.5, and the average is around 6.5. So if you just sort of believe or think we're going to revert to the mean, then volatility in those products are still very low. Back to equity indices, I don't think I've ever seen the VIX index at 12.5. I think we're at the lowest index level ever. Is that your understanding, Mark?
No. We've been lower in. We were lower in like 06. It actually briefly touched into the single.
Yeah, it touched single digits briefly, did it not? Yeah.
Yeah.
Oh,
but
okay.
we are at the lowest in nearly a half. In more than half a decade, and we're at what is considered historically low levels. Although we held 12.5 for months at a time back in 06.
Yes. Okay. I only looked at charts back to when VIX futures started. So I guess that was 07.
Since the dawn of the VIX future, you are 100% correct.
Yeah. Right. So now, what's my take? Now I would put words in Don's mouth. He would probably say, don't sell them at this point. I don't know if he would go and short them at 12.5 volatility on the VIX. Now I know, we're talking about futures or options, which aren't aren't quite at 12.5. But just looking at the index, the VIX index as an indicator, you probably shouldn't be selling them at this level. But with all this saber rattling going on, and the low volatility, if volatility was kind of average, or implied volatility was kind of average, I'd say, well, I really don't know what to do. But at these levels, the surprise factor is just too great with all these cliff things and debt limits and the Republicans saber rattling about they're willing to blow up the economy for our good kind of thing. I don't get it. Now this isn't a Republican versus Democrat kind of discussion. So
you get into dangerous waters there, Bob.
Yeah, there are as many Democrats that don't understand finance as Republicans, but the whole idea of they're trying to have some leverage, I guess, to reduce the debt. And why? Well, because they think at least altruistically that would put the economy on a better path. But they're willing to blow up the economy to put us on a better path. So it seems like really kind of goofy to me. So I don't know if it's just saber rattling.
Paul Krugman called. He wants his editorial back.
Oh, he said that?
No, that's so Krugman-esque. Well, you see, there's no real deficit problem and blah, blah, blah. No, I mean, I know exactly what you mean, Bob. And no, they basically said that there's going to be the big reason we're collapsing today is they came out and said we're going to wait 3 months. We're going to extend for 3 months.
I got it.
So before we go any further into these dangerous waters, that's going to do it for our crystal ball segment. And unfortunately, that's all the time we have for this episode of Volatility Views. But before we go, I like to check in with my cohorts here on the Volatility Views panel to see what they have going on in their respective necks of the woods. And starting off with you, Mr. Sebastian, what is coming up in the land of optionpit.com?
Bob, you'll like this. I got a Wednesday, 7:30 Eastern Time, 6:30 Central. I got a free webinar on introduction to volatility. We're going to talk about what is realized, what is implied, and what is forward volatility, and kind of teach people the difference and why you need to know all three.
Oh, excellent. Sounds great.
There you go. Very suitable for the listeners of the show, especially for our new listeners who want to learn some more about what we're talking about here on the show. You can join Mark and his guys over there, and they can walk you through it at length. And last but certainly not least, Bob, what is coming up in the land of volex.us?
Well, we are nearing completion of a new volatility strategy article. As you probably know, and Don has talked about, we have 4 of them now, and each one of them is, kind of research oriented. This one, issue number 5, is about VIX spreading. So spreading of real vol futures against VIX futures. And how do we do that when we don't have real vol futures yet? We calculate a theoretical price based on option values, just as we've done in some of the other volatility strategy articles. But we're now using that data to sort of show you what a spread between VIX and real vol futures looks like. So that should be out by next week. And so I was really kind of surprised at some of the results there too. So I'll let Don get into more of the specifics and what we found out, and then we'll post that on our website soon.
Well, we'll look forward to that, Bob. And I also want to thank our guest today, Randy Swan from Swan Wealth Advisors. Certainly a couple of great guests we've had on the show over the past few weeks, Bob. And it certainly is interesting to kind of reach out beyond what we traditionally talk about here on the show to explore some other aspects of volatility and volatility trading. Because you're right, Bob, it's not all about just VIX and NASDAQ vol. There's a lot of different areas of volatility to explore, and we like to do that here on the Volatility Views program. And before we go, I want to remind all of you out there in the listening audience that if you'd like to send us a question or a comment here on the Volatility Views program, you can do so just by surfing over to theoptionsinsider.com. You can use our comment system there to leave us a comment. You can shoot us an email via that comment system. Of course, you can just send us an email directly at questions@theoptionsinsider.com. Or, of course, you can find us on Twitter or Facebook. There are no shortage of ways to get in touch with us here and make your voice heard on the Volatility Views program. And maybe we'll dive into the mailbag again next week and see what you, the listeners, have to say. But for now, that's going to do it for this episode of Volatility Views. And of course, all of us here on the Volatility Views panel want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and continuing to make it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.